This is a more advanced investment video, so if you are a beginner, check out our other videos like Must-Know Investment Tips for Aspiring Investors and How to Invest with Limited Funds. Building wealth for financial freedom isn't just about making money, it's about strategically choosing assets that have the potential to generate substantial financial returns over time. Some of the most lucrative asset classes that can lead to wealth creation include private debt and direct lending, private equity investment, intellectual property and royalties, business ownership, and owning farmland. Each of these asset types offers distinct opportunities and risks, but with careful planning and execution, they can serve as powerful drivers of financial success. Private debt and direct lending have emerged as key components of an investment strategy aimed at generating high yields. Private debt refers to loans provided by non-bank institutions to businesses or individuals, often as an alternative to traditional bank financing. These loans may come in the form of direct lending, mezzanine financing, distressed debt, or venture debt. Unlike publicly traded bonds, private debt investments are usually negotiated directly with borrowers, offering customized terms that can lead to attractive risk-adjusted returns. Investors who engage in direct lending act as lenders to businesses seeking capital to fund operations, expand, or restructure. The advantage of private debt is its ability to provide predictable income streams through interest payments, often with returns higher than traditional fixed-income investments. Furthermore, private debt allows investors to diversify their portfolios beyond equities and public bonds. Private lenders can achieve higher yields because businesses borrowing outside traditional banks often agree to pay higher interest rates in exchange for more flexible borrowing arrangements. Average investors can access private debt through private debt funds. These funds pool investor capital and allocate it across a diversified portfolio of private loans, managed by professionals with expertise in credit underwriting. By investing in a private debt fund, individual investors gain exposure to high-yield opportunities while benefiting from professional risk management. Some private debt funds have lower investment minimums, making them more accessible to retail investors. Another option is peer-to-peer lending platforms, which allow individual investors to lend directly to borrowers via online marketplaces. These platforms facilitate loans for small businesses, personal borrowers, and real estate projects, providing opportunities for investors to earn interest income. Peer-to-peer lending platforms typically allow investors to select loans based on risk profiles, expected returns, and borrower credentials. This approach enables diversification, as investors can spread their capital across multiple loans to reduce risk exposure. Exchange-traded funds, ETFs, and publicly traded business development companies, BDCs, offer another way to gain exposure to private debt and direct lending. BDCs invest in private companies, often providing debt financing to support business growth. Since BDCs trade on public exchanges, retail investors can purchase shares and indirectly participate in private debt investments. Similarly, some ETFs focus on private credit and direct lending strategies, offering diversified exposure through publicly traded instruments. Private placement opportunities exist for accredited investors who meet specific income or net worth requirements. These opportunities allow investors to directly fund private debt transactions, such as mezzanine loans or venture debt deals. While these investments require due diligence and careful risk assessment, they offer potential for high returns. Investors interested in real estate-backed private debt can explore real estate crowdfunding platforms, private mortgage funds, and syndicated loan opportunities. These options involve lending capital to real estate developers or property owners in exchange for interest payments secured by real assets. Participating in private debt and direct lending requires an understanding of credit risk, borrower assessment, and portfolio diversification. Investors should evaluate opportunities carefully, considering factors such as interest rates, loan terms, creditworthiness, and potential economic impacts. While private debt can provide attractive yields, it is essential to conduct thorough research, assess risk exposure, and choose investment vehicles that align with financial goals and risk tolerance. Private equity investment is another lucrative asset class that has long been associated with wealth creation. Unlike public equity investments in stocks, private equity involves acquiring ownership stakes in private companies, often through venture capital, growth equity, leveraged buyouts, or distressed asset investments. Private equity firms pool capital from investors to buy, manage, and eventually exit these investments at a profit. The advantage of private equity investment lies in the ability to influence operational improvements, strategic growth initiatives, and financial restructuring to increase a company's value before selling it or taking it public. Private equity funds often deploy a high level of expertise in selecting undervalued companies and enhancing their profitability. Since private equity investments are illiquid and require long holding periods, they are best suited for investors who can commit capital for years. The upside potential of private equity investments is significant, especially for investors with access to deals involving high-growth companies or businesses with untapped market opportunities. Traditionally, private equity was reserved for institutional investors and high-net-worth individuals due to high capital requirements and long lockup periods. However, evolving financial markets and alternative investment structures have created opportunities for retail investors to gain exposure to private equity. One way average investors can access private equity is through publicly traded private equity firms. Some private equity companies trade on stock exchanges, allowing investors to buy shares and gain indirect exposure to private equity investments. These publicly traded firms operate similarly to private equity funds, acquiring businesses, restructuring them, and selling them for profit. Investors can participate without meeting accreditation requirements or committing large sums of capital. Another option is private equity exchange-traded funds and mutual funds. Some asset managers offer funds that invest in private equity-related assets, such as private equity firms, leveraged buyout deals, and venture capital investments. These funds provide diversification and lower investment minimums than traditional private equity funds. Business development companies also provide access to private equity. BDCs invest in private companies, offering debt or equity financing, and they trade on public exchanges. Retail investors can purchase BDC shares to gain exposure to private equity-style investments. Additionally, crowdfunding platforms and secondary marketplaces allow investors to participate in private equity deals. Some platforms enable investors to buy shares in private companies through fractional ownership, while secondary markets allow purchasing existing private equity fund interests. While private equity investing can be lucrative, it involves illiquidity and risk. Investors should conduct thorough research, understand fee structures, and assess portfolio diversification before committing capital. Intellectual property and royalties represent another way to generate substantial passive income. Intellectual property, IP, refers to creations of the mind, including patents, trademarks, copyrights, and trade secrets. Individuals and businesses that own IP assets can monetize them by licensing their rights to others in exchange for royalties. This model is particularly lucrative for creators, musicians, inventors, and brands that own proprietary knowledge or artistic works. Royalties offer a consistent and scalable income stream, allowing IP owners to benefit financially without having to actively work on their creations beyond the initial effort. For example, an author earns royalties on book sales, a musician receives royalties from streaming services, and an inventor licenses a patented technology to manufacturers for a percentage of sales. Some investors specialize in acquiring rights to intellectual property assets and generating income by licensing them to third parties. Additionally, franchises utilize IP in the form of trademarks and brand recognition, creating revenue streams through licensing deals with franchisees who operate under established brand identities. Business ownership is a proven avenue to wealth creation. Owning a business allows individuals to take control of their financial destinies, offering scalability and unlimited earning potential. Entrepreneurs who build successful enterprises can enjoy substantial profits, leverage their capital for expansion, and reinvest earnings to multiply their wealth. Unlike traditional employment, where income is limited to salaries and wages, business ownership enables wealth accumulation through reinvestment and operational efficiency. High-growth businesses can achieve scalability through product expansion, strategic partnerships, market penetration, and innovative business models. Additionally, business owners have the flexibility to structure their companies to maximize tax advantages, optimize cash flow, and expand globally. Many successful business owners diversify their income streams by investing in multiple ventures, leveraging their expertise, and acquiring assets that complement their core operations. A well-managed business can provide a lifetime of financial stability, making entrepreneurship a valuable path to wealth creation. Owning farmland is another asset that can generate wealth over time. Agricultural land has intrinsic value due to its productive capacity, and it tends to appreciate as demand for food, biofuels, and agricultural commodities increases. Farmland investments offer multiple avenues for wealth generation, including leasing land to farmers, engaging in crop production, or integrating sustainable agriculture practices that increase profitability. Unlike residential real estate, farmland often provides stable returns because agricultural products remain in constant demand regardless of economic fluctuations. Investors in farmland can benefit from land appreciation, government subsidies, and the potential for renewable energy projects, such as solar farms or wind energy installations on agricultural land. Additionally, farmland can be leveraged through innovative techniques such as agribusiness ventures, organic farming, and export-oriented agricultural production. Historically, farmland has been a reliable asset for wealth preservation and generation, attracting investors looking for stable, inflation-resistant opportunities. Check out our other videos to learn more about how to become financially free.